Last night, Iran launched another missile strike, and this time, they did not miss. They hit the Bazan refinery in Haifa, which is Israel's largest oil refinery. This is the facility that processes roughly 40% of all the fuel Israel uses domestically. Now, most people are going to cover this as a military story. And yes, the military angle matters. But I am not here to talk about missiles. I am here to talk about what happens next. What happens to oil prices, to Israel's economy, to the broader war effort, and to you, if you have money in the market, a car that runs on gas, or a retirement account that you would like to still exist in 6 months. Because here's the thing. This is not just a refinery. This is a strategic turning point, and almost nobody in the financial media is connecting the dots fast enough. So let us do that right now. Here is what we are covering today. First, what exactly is the Bazan refinery, and why does it matter so much beyond Israel's borders? Second, the immediate impact on oil markets, because Brent already moved, and I will tell you where I think it goes from here. Third, what this does to Israel's war-fighting capacity. This is not just economic damage, this is a military supply chain problem now. Fourth, Iran's strategy here, because this was not random. This was calculated. I will explain why Haifa, why now, and what the next target probably is. And fifth, what this means for you if you are holding energy stocks, defense stocks, or just trying to figure out whether to fill up your tank today or wait. Let us get into it. Okay, first things first. Let me tell you what we are actually talking about, because most people have no idea how important this facility is. The Bazan Group, officially called Israel Oil Refineries, is located in the Bay of Haifa in northern Israel. It has been operating since 1939. Let that sink in. This refinery is older than the state of Israel itself. It processes somewhere in the range of 9 to 10 million tons of crude oil per year. That is roughly 180,000 to 200,000 barrels per day. For context, that is a significant chunk of Israel's entire fuel supply. Jet fuel for the Israeli Air Force. Diesel for tanks and military logistics. Gasoline for the civilian population. Petrochemicals that feed Israeli industry. We are not talking about a symbolic target. We are talking about the single most important piece of energy infrastructure in the entire country. Now, here is something most Western media coverage will not tell you. Bazan has been previously threatened, previously targeted with rocket fire from Lebanon and Gaza in past conflicts, and the Israelis have built substantial defensive systems around it specifically because they know how catastrophically important it is. So the question you have to ask is, how did this missile get through? That is a question for the military analysts, but the economic question, the one that matters for this channel is, what does it mean now that it is damaged or destroyed? And that answer, honestly, is scary. Let us start with what we know about the immediate economic impact. Number 1, fuel supply shock inside Israel. If Bazan's capacity is significantly reduced, and early reports suggest serious structural damage, Israel will have to rapidly increase fuel imports to compensate. That means more tankers, more exposure at sea, more logistical complexity in the middle of an active war, and more cost. Number 2, oil markets globally. The second this news broke, crude prices moved. And look, traders are not just reacting to Haifa, they are running scenarios. If Israel's refining capacity takes a major hit, does that accelerate any Israeli decision-making about striking Iranian oil infrastructure in retaliation? Because that scenario, a tit-for-tat targeting of each other's energy infrastructure, is what the oil market genuinely fears. There is a term for this in geopolitical risk modeling: infrastructure warfare. And once both sides start playing that game, the escalation logic almost runs itself. Number 3, the Strait of Hormuz again. Any major escalation in the Israel-Iran exchange puts renewed pressure on the strait. Iran has already demonstrated it is willing to threaten passage. A direct exchange of infrastructure strikes between Israel and Iran could be the trigger that takes us from a threatened closure to an actual closure. And if that happens, we are not talking about oil at $85 or $90. We are talking about oil at 120, 140, maybe higher. I know that sounds extreme. But look, 6 weeks ago, the idea of Iran successfully striking Haifa's main refinery also sounded extreme to a lot of people. Here we are. Now let me give you my honest read on Iran's strategic logic here, because I think this is important and it is being underreported. The conventional wisdom has been that Iran fights through proxies, Hezbollah, Houthis, militias in Iraq and Syria. It does the damage, but keeps itself at arm's length to avoid direct retaliation. That calculus changed when the United States and Israel launched direct strikes on Iranian territory. Iran is now in a different posture. It is no longer trying to avoid being seen as a direct combatant. It is trying to redefine the rules of engagement, essentially saying, if you hit us directly, we hit you directly. And we are going to hit you where it hurts. And where does it hurt? Not population centers. That triggers international condemnation and a massive military response. The smarter play, from Iran's perspective, is critical infrastructure. Refineries, power plants, port facilities, things that degrade your enemy's capacity to sustain a long war. Haifa is the perfect target in this logic. It is strategic. It is economically devastating. It is not a civilian massacre, so it limits international blowback. And it sends a message to every Israeli citizen. Your government's military adventure has consequences at home. My honest opinion? This is not a random escalation. This is a deliberate strategic shift by Iran toward infrastructure warfare. And that means Haifa probably isn't the last target. The ports, the Ben Gurion airport fuel depots, the electricity grid. These are all on the table now. Whether Iran has the precision capability to hit them consistently is a different question. But the intention is clearly there. And the United States has to now make a decision. Do we help Israel defend this infrastructure? Do we preemptively strike Iranian missile capabilities? Or do we try to bring both sides to the table before this spiral goes further? That decision, whatever it is, will move markets. Let us be real about the American position here. The Trump administration launched this war with a specific set of objectives: destroy Iran's nuclear program, degrade its missile capabilities, and do it fast enough that the economic disruption stays manageable. The strike on Haifa complicates all three of those objectives. First, it shows that Iran's missile program has not been sufficiently degraded. They still have precision strike capability to hit targets hundreds of miles away through Israeli air defenses. That is a significant intelligence and military planning failure that Washington now has to explain. Second, it puts enormous political pressure on Netanyahu to respond, and to respond hard. And the harder Israel responds to Iranian territory, the more likely Iran escalates further. The administration wanted a short, controlled conflict. They are getting an escalating back and forth that is increasingly hard to control. Third, and this is the economic angle, if this conflict is going to be longer and more destructive than the White House originally projected, the markets will start pricing that in now. You will see it in defense stocks. Lockheed, Raytheon, Northrop Grumman will likely continue to outperform. You will see it in oil futures. You will see it in gold. And you will see it in consumer sentiment numbers in about 3 to 4 weeks, once higher fuel prices start showing up at the pump and in grocery bills. Okay, you stayed for this part. Let me give you my actual take on what to watch. Oil and energy stocks. In the short term, any major escalation, and a successful strike on Haifa is by definition a major escalation, is bullish for oil prices and energy companies. If you hold ExxonMobil, Chevron, or broader energy funds like XLE, this is the kind of event that has historically pushed those assets up 3 to 7% in the week following a major supply disruption. I am not giving you financial advice. I am telling you what the data has historically shown. Defense stocks. Lockheed Martin, Raytheon, Northrop Grumman, L3 Harris. These had been on a tear since the war started. A strike that demonstrates Iran still has meaningful offensive capability accelerates United States and Israeli procurement. More contracts, more revenue. The market knows this. Inflation hedge assets. Gold and Treasury inflation-protected securities, or TIPS, tend to perform well when geopolitical risk spikes and when oil prices push up near-term inflation expectations. Gold has already been strong. This event reinforces that trade. What I would be cautious about: airlines, heavily leveraged consumer companies, and any sector that depends on European consumer demand. If this escalation pushes oil toward $100 and above, European consumers, who are already squeezed, will pull back hard. That ripples through global consumer stocks. And the wild card? The Israeli tech sector. Israel has one of the most sophisticated technology ecosystems in the world. Tel Aviv is a global startup hub. If the war escalates to the point of significant civilian disruption, like power grid attacks or fuel rationing, that tech ecosystem takes a major hit. Global venture capitalists and institutional investors with heavy Israel exposure are watching this very carefully right now. None of this is certain. War is inherently unpredictable. But this is how I am reading the board. Let me zoom out for a second, because I think there is a bigger story here that the daily news cycle keeps missing. We are watching in real time the first full-scale infrastructure war in the Middle East between two major military powers. Previous conflicts in the region targeted troops, weapons depots, and command centers. What we are seeing now is different. Both sides are going after the systems that keep modern economies running. Refineries, power grids, ports, supply chains. And this matters beyond Israel and Iran, because the global economy is not designed to absorb this kind of sustained infrastructure destruction in a critical region. The Strait of Hormuz carries 20% of the global oil supply. The Bay of Haifa connects Mediterranean shipping to Middle Eastern energy flows. The Houthis are still active in the Red Sea, threatening another 10 to 12% of global trade. These are not separate stories. They are one interconnected story about the structural fragility of global supply chains. Here is the uncomfortable truth. The world spent the last 30 years building a hyper-efficient global economy that eliminated backup systems to cut costs. Just-in-time manufacturing, single-source energy dependencies, minimal strategic reserves. It was great for corporate profit margins. It is terrible for resilience. And now we are stress testing that system in the worst possible way, in real time, with no clear way out. The strike on Haifa is not just a headline. It is a data point in a larger trend. And the trend is, this war is becoming more destructive, more unpredictable, and more economically consequential than anyone in Washington originally expected. I think that is important to say clearly, because the official narrative, both from the White House and from some corners of the financial media, is still treating this as a manageable, contained situation. It is not contained. The Bazan refinery burning in Haifa is proof of that. Look, I want to be straight with you about something. I do not know how this ends. Nobody does. Anyone who tells you they have a clear prediction about how this war resolves and what oil prices will be in 6 months is either lying to you or lying to themselves. What I can do is give you the clearest possible read of what is happening right now, what the data says, and what the logical implications are, so that you can make informed decisions about your money, your planning, and how you are thinking about the next 12 months. Here is my summary of where we are after the Haifa strike. 1. Iran has demonstrated it can still conduct precision strikes on strategic Israeli infrastructure. That is a significant military development. 2. The risk of further infrastructure warfare on both sides has just increased substantially. That means elevated oil prices for longer. 3. The United States faces a strategic choice point. How it responds in the next 72 hours will significantly shape the trajectory of this conflict and the markets. 4. If you are not paying attention to energy, defense, and inflation hedge positions right now, you probably should be. That is my honest take. As always, do your own research. I am one voice, but I am a voice that is going to keep covering this every time there is a significant development. Without spin, without an agenda, just the analysis. If this was useful to you, subscribe. Share it with somebody who needs to understand what is actually going on. Drop a comment below with what you think happens next. I read all of them. I will see you in the next one.